Every trader has been taught on how to spot a trend. Your Forex courses have taught you that. Your mentors have taught you that. Even your favorite YouTuber have taught you that. But have you ever noticed that nobody wants to talk about the most important question, which is why do trends exist in the first place? What is the forces behind trend existence? Well, the answer is pretty much simple. Trend exists because one side of the market is stronger than the other side. That's why you see the market moves in one direction for a long time. Well, in the course of the video, we'll break down these facts into concept that is quite digestible. So before we go ahead to understand why trend exists, we first of all want to examine what actually is a trend. A trend is a period of time when a market consistently moves in one direction. So for those of you who are just new to trading, this is what an uptrend looks like, and this is what a downtrend looks like. Simple, right? But this actually leaves a more deeper question. Why do trends exist in the first place? So every candle in your chart is an evidence of a battle. Not between indicators, not between chart patterns, but between buyers and sellers. Every second, thousands of market participants are making decisions. Some believe price should go higher, others believe it should fall. Those opposing decisions create a constant struggle for control. Most of the time, neither side dominates for a very long time, but occasionally something changes. One side begins to overwhelm the other, and that's where trends are born. Imagine investors around the world reaching the same conclusion. This asset is worth buying. As more buyers order enters the market, demands begin to outweigh supply. There are simply more people willing to buy than willing to sell at the current price. Price responds by moving higher. If buyers continue entering the market faster than sellers can absorb them, the upward movement continues. One trader noticed a rising price. Some join because they believe the trend will continue. Others join because they fear missing the opportunity. This creates a chain reaction, and that chain reaction is what we recognize as an uptrend. The opposite happened during a downtrend. Investors start believing that an asset is about to lose value. Selling pressure starts increasing. Supply becomes stronger than demand. Price begins falling.
Support isn't holding.
As the decline continues, more traders become fearful. Some close their position to avoid larger losses. Others begin selling because they expect even lower prices. This aids even more selling pressure. The trend strengthens itself. Market don't suddenly decide to trend. Something shifts the balance. Sometimes it's economic news. Sometimes it's an interest rate decision. Even a company earning report, maybe is even a changing market sentiment, or it's even greed, and often is a large institutional investors moving significant amount of money. The causes may be different, but the result is always the same. One side gains control. Many people believe that trends are random.
They're not.
A trend continues because market participants continues reaching similar conclusions. As long as buyers remain more aggressive than sellers, price continues climbing. As long as sellers remain more aggressive than buyers, price continues falling. Think about it like pushing a car. One person may barely move it, but when dozens of people push together in the same direction, the car keeps rolling. Financial markets behave in much the same way. Thousands, even millions of participants acting in the same direction create a sustained movement we call a trend. Now let's bring this back to the chart. Every candlestick tells part of the story. In an uptrend, you often notice more bullish candles, strong closes near highs and higher lows. These are signs that buyers continue winning the battle. In a downtrend, you often notice more bearish candles, strong closes near lows, lower highs and lower lows. These are signs that sellers remain in control. Candlesticks don't create the trend, they simply reveal who is winning. So you might want to ask again, why do trends actually exist? Trends exist because financial markets are driven by supplies and demand. When buyers consistently overpower sellers, price trends upward. When sellers consistently overpower buyers, price trends downward. A trend is not a magic. A trend is not even random. It is the visible footprint of millions of buyers and sellers' decisions unfolding over time. So the next time you look at the chart again, don't just ask whether the market is trending, but ask why. What is the reason why the market is trending? Because every candle is an evidence of an ongoing battle, and every trend is the footprint left behind by the side that won that battle. So with that being said, I'll see you guys in our next video. Bye for now.